There's a phrase you hear on Wall Street, a piece of folk wisdom, repeated so often it's mistaken for a universal truth. You'll hear it from financial news anchors in expensive suits, from your well-meaning uncle, from the day trader on social media flashing a screenshot of a small, quick win. The phrase is, take profits. It sounds so sensible, so prudent. You bought a stock, it went up, and now you sell it to lock in your gain. You can't go broke taking a profit, they say. It feels good, it feels smart, it feels like you've beaten the market. But what if this piece of common sense is not just wrong, but catastrophically, wealth-destroyingly wrong? What if the very act of taking profits is the single biggest reason most people fail to build significant, life-altering wealth in the stock market? Warren Buffett, the man who turned a failing textile mill into a $500 billion empire, has a different philosophy. His default holding period for a wonderful business is not 1 year, or 5 years, or even 10. His default holding period is forever. The very idea of selling a great asset simply because its price has gone up is, in his view, an act of financial insanity. It's like owning a goose that lays golden eggs and selling it after it lays the 10th egg, congratulating yourself on the profit you made on the goose, while completely ignoring the lifetime of golden eggs you just forfeited. This isn't just a quaint preference, it is the central operating system of his wealth creation machine. He understands that true wealth isn't built by hopping from one investment to another, skimming small profits along the way. It's built through the relentless, explosive power of uninterrupted compounding, by owning the great enterprises of the world and letting them work for you, day and night, for decades. So if forever is the default, what could possibly compel him to sell? The answer is not a complex algorithm or a secret market signal. It is a ruthlessly simple, brutally logical 3-point checklist. And only when a business fails this checklist does he even consider parting with it. Understanding these 3 reasons is more than just an academic exercise. It is the key to rewiring your brain, to shifting your perspective from that of a nervous speculator to that of a confident long-term business owner. It is the framework that prevents the costliest mistake in all of investing, cutting your flowers to water your weeds. Today we are not just going to list these 3 reasons. We are going to deconstruct the entire philosophy behind them. We will journey through the foundational principle that makes this strategy possible. And then we will examine, one by one, each of the 3 sacred exit triggers. This is the final promise of value investing. It's the moment you stop asking, when should I sell, and start understanding why. For the truly great investments, the answer is almost always never. Our journey begins not with an exit, but with an entrance. It begins with understanding the bedrock principle upon which Buffett's entire selling philosophy is built, the forever mandate. This isn't just a catchy phrase. It is a profound strategic commitment to inertia. In a world that prizes action, speed, and constant decision-making, Buffett's greatest advantage is his cultivated ability to do nothing. He understands that for a superior business, time is not a risk to be managed, but a force to be harnessed. To truly grasp this, we have to travel back to one of the darkest moments in modern market history, a time of panic and fear, and witness the birth of what would become one of the greatest investments of all time. The year was 1988. The financial world was still reeling from the shock of Black Monday, October 19, 1987. When the Dow Jones Industrial Average had plummeted by nearly 23% in a single day. It was the largest one-day percentage drop in the market's history. Fear was palpable. Investors, both professional and amateur, were convinced that the good times were over, that a new Great Depression was just around the corner. They were dumping stocks indiscriminately, desperate to get to the perceived safety of cash. In this environment of widespread terror, Warren Buffett was doing what he always does. He was reading. He was reading annual reports, industry publications, and historical documents. And one company in particular had caught his attention for years, a company whose product was so ubiquitous, so deeply embedded in the global culture, that it was practically invisible. The Coca-Cola Company. Buffett had observed Coca-Cola for decades. He'd seen its resilience through wars, recessions, and changing consumer tastes. He understood its simple but profound business model. Sell a product for $1 that costs pennies to make, and do it billions of times a day, all over the world. He was a customer himself, famously consuming multiple Cokes a day. But it wasn't just the product he loved, it was the economics. He saw what others, in their panic, were missing. He saw a company with a global distribution network that was virtually impossible to replicate. He saw a brand that wasn't just a name on a can, but a powerful piece of mental real estate in the minds of billions of people, synonymous with happiness and refreshment. This was a moat, a deep, wide, alligator-infested moat, protecting a glorious economic castle. The 1987 crash didn't damage that moat. It didn't change the taste of Coke or diminish its brand power. All it did was put the castle on sale. While others were selling out of fear, Buffett was buying out of conviction. Over a period of several months in 1988, Berkshire Hathaway began to accumulate a massive position in Coca-Cola. By the end of the process, he had invested over $1 billion, acquiring a stake of around 7% of the entire company. At the time, this was an enormous bet, the largest single investment Berkshire had ever made. The financial press was skeptical. Many analysts thought Coke's best days were behind it, that the era of sugary drinks was waning. But Buffett wasn't buying a quarterly earnings report or a stock chart trend. He was buying a piece of a global institution for what he believed was a fraction of its intrinsic value. And then, he did the most important thing. He did nothing. He held. He held through the minor recession of the early 1990s. He held through the dot-com bubble of the late 90s, when Wall Street was laughing at his old economy stocks. He held through the bust that followed. He held through the 2008 financial crisis, the greatest economic collapse since the Depression. He just held. And what happened? That $1 billion investment blossomed. It grew and grew, but more importantly, the business itself flourished. Coca-Cola expanded its reach, increased its dividends, and bought back its own stock, making Berkshire's remaining shares even more valuable. Today, that initial investment is worth well over $20 billion. But that's not even the most stunning part of the story. The annual dividend that Berkshire Hathaway now receives from its Coca-Cola shares is more than half of its entire original cost basis. Think about that. Every 2 years, Buffett gets his entire billion-dollar investment back in cash, just for holding on, and he still owns the goose that lays those golden eggs. This is the forever mandate in action. It's the understanding that the big money is not made in the buying or the selling, but in the waiting. It's the discipline to identify a truly wonderful business and then have the patience to let the power of compounding work its silent, relentless magic for decades. This ability to hold on, to sit still for decades while a great business compounds, seems almost superhuman. Why is it so difficult for the average person? The answer lies deep within our own psychology. Our brains are hardwired with cognitive biases that make the forever holding period feel unnatural and risky. Two of the most powerful of these are the endowment effect and the status quo bias. The endowment effect is the simple, well-documented phenomenon where we place a higher value on something simply because we own it. If you give someone a coffee mug and then offer to buy it back, they will typically demand a much higher price than they would have been willing to pay for it in the first place. Ownership itself creates an emotional attachment that inflates our perception of value. Status quo bias is its close cousin. It's our innate preference for the current state of affairs. Any change from that baseline is perceived as a potential loss, and our brains are highly sensitive to losses. Now, on the surface, it might seem that Buffett is simply a master of these biases. He buys a stock, becomes endowed with it, and his preference for the status quo makes him want to hold it forever. But that's a dangerous misinterpretation. Most investors fall victim to these biases in a passive, irrational way. They hold onto a stock because they are emotionally attached to it, or because the thought of admitting a mistake and making a change is too painful. They hold onto their weeds because they own them. Buffett does the opposite. He actively and rationally harnesses these powerful psychological forces to his advantage. He creates a system where inertia is the most powerful force in his investment universe. His default setting, the status quo he defends with incredible intellectual rigor, is "I will never sell this business." By setting this as his default, he completely flips the script on the decision-making process. For the average investor, the daily question is, should I sell today? Should I take my profits? Should I cut my losses? It's a question that invites action and churn. For Buffett, the question is, has something happened that is so significant, so world-altering, that it can overcome the immense gravitational pull of my forever mandate? This creates an incredibly high hurdle for any sell decision. It's no longer a casual choice, it's a monumental event that must be justified with overwhelming evidence. He is weaponizing inertia. This approach also serves as a powerful antidote to another pervasive cognitive bias: action bias. Humans have a tendency to favor action over inaction, even when inaction is the more rational course. In the world of investing, this manifests as a constant urge to do something. The market is volatile, the news is screaming, and the pressure to react is immense. Traders feel they are earning their keep by trading. Buffett understands that in long-term investing, activity is often the enemy of returns. His greatest insights, his most profitable decisions, were not moments of frantic activity, but years of patient inactivity. By establishing forever as his baseline, he short-circuits the action bias. He has given himself permission, indeed, he has given himself a mandate, to do nothing. This psychological framing is everything. It transforms him from a participant in a chaotic market into an observer of long-term business trends, immune to the daily noise and emotional whims that derail the vast majority of market participants. So how can we, as individual investors, translate this profound philosophy into a practical, repeatable process? It requires building a mental model, a blueprint that guides our decisions and fortifies our resolve. The first and most crucial step is a fundamental mindset shift. You must stop thinking of yourself as someone who buys and sells stocks. A stock is just a ticker symbol, a flickering price on a screen that invites speculation. Instead, you must begin to think of yourself as a silent partner in a collection of private businesses. When you buy shares in Apple, you are not just buying a piece of paper with the ticker AAPL. You are buying a fractional ownership stake in a global consumer electronics and services empire. You are a part owner of the iPhone, the App Store, the brand, the supply chain. Your goal is not to guess where the ticker will go tomorrow, but to assess whether that business empire will be larger, more profitable, and more dominant in 10, 20, or 30 years. This shift is the foundation for everything that follows. The second step is to implement what we can call the pre-mortem purchase analysis. Before you ever click the buy button, you must sit down with a blank piece of paper or a new document and write down, in clear and simple language, the specific, quantifiable reasons you believe this business will be worth significantly more in the distant future. Don't write, "I think the stock will go up." Write, "The company has a network effect that makes it difficult for new competitors to gain traction. They have a history of high returns on invested capital, suggesting a durable competitive advantage. The management team has a proven track record of intelligent capital allocation." This document becomes your constitution for this investment. It is the thesis you are betting on. Years later, when you are tempted to sell, you will not look at the stock price. You will return to this document and ask a single question: are these fundamental truths still valid? The third tool in this blueprint is Buffett's famous punch card analogy. Imagine that at birth, you are given a punch card with only 20 holes in it. Each time you make an investment, you have to punch a hole. That's it. You get 20 investment decisions for your entire life. Suddenly, the idea of a casual, speculative trade becomes unthinkable. You would conduct enormous amounts of research. You would think for weeks or months. You would demand a huge margin of safety. You would only swing at the fattest, most obvious pitches. And once you punched that card, you would intend to hold that investment for a very, very long time, because your decision-making capital is extraordinarily scarce. While you don't actually have a 20-punch limit, adopting this mindset forces the extreme selectivity and long-term commitment that is necessary for this strategy to work. Finally, you must architect your environment to support this long-term view. This means setting a new default behavior. Delete the stock market app from your phone's home screen. Stop watching financial news channels that thrive on sensationalism and short-term panic. Instead, create a new ritual. Schedule a quarterly check-in for each of your businesses. During this check-in, you will not look at the stock price. You will read the company's quarterly earnings report. You will read the CEO's letter to shareholders. You will act like a business owner, checking in on the operational performance of your enterprise, not like a gambler checking the latest odds. By adopting this four-part blueprint, the business ownership mindset, the pre-mortem analysis, the punch card mentality, and the structured check-in process, you begin to build the intellectual and emotional scaffolding required to hold great businesses for the long run. Now let's explore the opposite path, the well-trodden road that 99% of market participants take. This is the path of constant activity, of chasing trends, and of a relentless focus on taking profits. It's a world dominated by the belief that you can outsmart the market through frequent trading. The siren song of this approach is powerful. It offers the instant gratification of a closed trade, the dopamine hit of seeing a realized gain in your account. The financial media glorifies it, creating a perpetual motion machine of hot stocks, market timing strategies, and expert predictions. The result is a portfolio in constant churn where assets are bought and sold based on short-term price movements rather than long-term business value. Consider the story of an investor. Let's call him Tom. In 2005, Tom reads about a quirky online bookseller called Amazon that is starting to sell other things. He sees its potential and invests $10,000, buying shares at around $40. Over the next 2 years, the stock doubles to $80. Tom is ecstatic. He's made a 100% return. All his friends are impressed. The voice of Wall Street whispers in his ear, "You can't go broke taking a profit. Lock it in before it disappears." So he sells. He takes his $10,000 profit and feels like a genius. He has successfully played the market. But what did he really do? He sold his fractional ownership in one of the most explosive and dominant economic engines in human history for a pittance. He cut his magnificent flower to water the weeds of his other, less successful ideas. Had he simply done nothing, had he understood that he owned a business and not just a stock, his initial $10,000 investment would have grown to be worth more than $1.5 million. His single decision to take profits cost him a fortune. This behavior is driven by a deep-seated fear, a cognitive bias known as loss aversion. Studies have shown that the psychological pain of a loss is about twice as powerful as the pleasure of an equivalent gain. When an investor like Tom sees his Amazon stock double, his dominant emotion is not greed for future gains, but fear that the current gain will evaporate. The desire to avoid the pain of watching his winning position turn into a losing one becomes overwhelming, and it compels him to sell far too early. The 99% path is also paved with a fundamental misunderstanding of where wealth comes from. They believe wealth is generated by their cleverness, by their ability to time buys and sells. The truth, as Buffett knows, is that real wealth is generated by the businesses themselves. It comes from the earnings they produce, the innovations they create, and the markets they conquer. The investor's job is not to be clever, but to be a patient and loyal partner to these great wealth-generating machines. By constantly trading, investors are not only interrupting this process, they are actively working against it. The financial consequences of choosing the forever mandate over the path of the 99% are not subtle. They are monumental, and they manifest directly in your financial statements in two critical ways: the magic of uninterrupted compounding and the powerful advantage of tax efficiency. First, let's talk about compounding. Albert Einstein supposedly called it the eighth wonder of the world. But most people who take profits never get to experience its true power because they are constantly interrupting the process. Imagine you have two investors, both starting with $10,000, and both are skilled enough to pick investments that generate a 15% annual return. Investor A is an active trader. At the end of every 2 years, she sells her holding, pays her taxes on the gain, and reinvests the remainder. Investor B is a Buffett-style holder. She buys a great business and doesn't touch it. Let's trace their journeys over 30 years. Investor A's $10,000 grows to about $13,225 after 2 years. She sells. And let's assume a combined federal and state long-term capital gains tax of 20%. She pays $445 in taxes, leaving her with $12,780 to reinvest. She repeats this process every 2 years. After 30 years, her initial $10,000 will have grown to approximately $250,000. A respectable return, to be sure. Now let's look at Investor B. Her $10,000, compounding at 15% a year without interruption, grows relentlessly. She pays no taxes along the way because she never sells. After 30 years, her initial $10,000 is worth over $662,000. That's more than 2.5 times the amount Investor A ended up with, simply by doing nothing. The difference of over $400,000 is the, quote, cost of interruption. It's the price paid for taking profits and resetting the compounding clock over and over again. The second and equally powerful financial connection is tax efficiency. When you own a stock that appreciates in value, you have an unrealized capital gain. As long as you don't sell, you don't owe any tax on that gain. The government doesn't send you a bill each year for your portfolio's growth. This is a concept of profound importance. By deferring your capital gains taxes, you are essentially receiving an interest-free loan from the government. That money, which would have been paid in taxes, remains in your account, working and compounding for you. In our example, Investor A was constantly sending a piece of her compounding machine to the IRS. Investor B kept her machine fully intact, allowing every single dollar to continue working for her benefit. This is a structural advantage that is central to any serious wealth management strategy. The longer you can defer taxes, the more powerful the tailwind of compounding becomes. By adopting the forever mandate, you are not just making a philosophical choice, you are making a decision that has a direct, quantifiable, and massive positive impact on your long-term net worth. You are choosing the path of exponential growth over linear gains, a decision that separates the merely successful investor from the one who achieves true financial freedom. The forever mandate is the default, the powerful state of inertia that protects us from our own worst instincts. But it is not absolute. Buffett is a pragmatist, not a dogmatist. He knows that the world changes, that moats can dry up, and that even the best investors make mistakes. And so, he has established 3 specific, intellectually rigorous reasons that can override his powerful bias to hold. These are his escape hatches, his emergency pull cords. The first and perhaps most important exit trigger is when the long-term business prospects of a company have fundamentally and enduringly deteriorated. Notice the wording. It's not about a bad quarter. It's not about a temporary stock price decline. It's not about the CEO saying something foolish on a conference call. It is a deep, structural, and likely permanent decay in the company's economic castle. There is no better modern example of this principle in action than Buffett's dramatic and swift sale of Berkshire Hathaway's entire position in the 4 major U.S. airlines in the spring of 2020. For years, Buffett had famously derided the airline industry as a death trap for capital. He joked that a far-sighted capitalist should have shot down Orville Wright at Kitty Hawk. The industry was characterized by brutal competition, high fixed costs, powerful unions, and sensitivity to fuel prices, leading to perennial bankruptcies. But by 2016, something had changed. The industry had gone through a wave of consolidation. Fewer major players meant less cutthroat competition on routes and pricing. They had become more rational. Seeing this new industry structure, Buffett changed his mind and invested heavily, acquiring significant stakes in American, Delta, Southwest, and United, totaling more than $7 billion. At his 2018 shareholder meeting, he explained his logic, suggesting the industry was no longer a suicidal competition. He had made a bet that the fundamental business dynamics had improved for the long term. Then, in early 2020, the world changed. The COVID-19 pandemic swept across the globe, bringing travel and commerce to a screeching halt. Airplanes were grounded, borders were closed, and fear of flying became rampant. For the airlines, it was a cataclysm. Their revenue evaporated overnight, while their massive fixed costs, airplanes, maintenance, and much of their labor remained. They were burning through billions of dollars in cash just to survive, taking on huge amounts of debt and issuing new stock, which diluted existing shareholders. At Berkshire Hathaway's virtual shareholder meeting in May 2020, a somber Warren Buffett made a stunning announcement. He had sold everything. The entire multi-billion-dollar position in the airlines was gone, and he had likely sold it at a significant loss. He explained his reasoning with stark clarity. The world has changed for the airlines. He acknowledged that air travel would eventually come back, but he believed the industry's future potential for earnings had been severely damaged. The companies were going to be smaller, more heavily indebted, and facing a public whose travel habits might be permanently altered. The attractive economic characteristics that had prompted his initial investment were gone. The moat had not just been damaged, it had been vaporized by a global shock. This was the first exit trigger in its purest form. It was not an emotional, panic-driven decision. It was a cold, rational assessment that the facts had changed, and therefore his thesis was no longer valid. He didn't wait and hope for a quick recovery. He didn't average down. He recognized that the long-term story was broken, and he acted decisively to move his capital out of a deteriorating situation. Why is this so difficult for most people to do? Why do so many investors cling to a failing business, riding it all the way down to zero? The answer lies in two powerful psychological traps: the sunk cost fallacy and commitment bias. The sunk cost fallacy is our tendency to continue with an endeavor if we have already invested time, money, or effort in it, even when the current evidence suggests it is no longer the best course of action. The money we've already spent is sunk, it's gone, and can't be recovered. A rational decision-maker should only consider the future prospects of the investment, but our brains hate to accept that a past investment was a waste. We feel that if we just stick with it a little longer, we can make our money back. This leads to the classic behavior of throwing good money after bad, pouring more capital into a failing project in a desperate attempt to justify the initial investment. Commitment bias, also known as escalation of commitment, is closely related. Once we have publicly or privately committed to a particular belief or decision, we feel a deep psychological pressure to remain consistent with that commitment. To reverse course is to admit we were wrong, which is a painful blow to the ego. So instead of rationally reevaluating the situation, we dig in our heels. We start to filter information, paying more attention to any small piece of good news while dismissing the mounting evidence of failure. This is why you see investors who are deeply invested in a failing company become its most ardent cheerleaders, frequenting online forums and attacking anyone who presents a negative view. They are no longer objective analysts. They are defending their past decisions and their own sense of identity. Warren Buffett's genius is his almost complete immunity to these biases. His decision to sell the airlines was a masterclass in overcoming the sunk cost fallacy. He had invested billions of dollars. He had spent years changing his public stance on the industry. A lesser mind would have been trapped by the sheer weight of that prior commitment. They would have said, "I can't sell now," I'd be admitting I made a huge, very public mistake. Buffett's mind doesn't work that way. The money was already sunk. The only question that mattered to him was, if I had that capital in cash today, would I invest it in the airlines given their new reality? The answer was a clear and resounding no. And so he sold. He is famous for saying, quote, "The most important thing to do if you find yourself in a hole is to stop digging." It sounds simple, but it requires a level of emotional detachment and intellectual honesty that very few people possess. He is able to separate his ego from his investment decisions, treating past choices not as a source of pride or shame, but simply as data. The facts changed, so he changed his mind. It is this radical objectivity that allows him to act decisively when a business has fundamentally deteriorated, preserving capital that others would ride all the way to the bottom. To apply this principle with Buffett-like discipline, you need a systematic tool, not just a gut feeling. You need a moat erosion checklist. This is a practical framework for determining whether a company's competitive advantage is truly deteriorating, or if it's just facing a temporary headwind. The process begins by returning to your pre-mortem purchase analysis, the document you created before you ever bought the stock. The first question on your checklist is simple. Are the original reasons I bought this business still fully intact? If you bought it for its dominant brand, has that brand been tarnished? If you bought it for its visionary founder, has that founder left or lost their touch? This document is your North Star, grounding your analysis in your original thesis. Next, your checklist should be structured around the 4 primary types of economic moats. For each business you own, you need to identify its primary moat and then monitor it for cracks. The first is intangible assets, like brands, patents, or regulatory licenses. Your checklist question might be, is there evidence of declining brand power, such as consistently losing market share to a competitor? Is a key patent about to expire, opening the floodgates to generic competition? The second moat is switching costs. This is the pain, expense, or hassle a customer would have to go through to switch to a competitor. For a software company, your question might be, has a new competitor emerged with a product that is so much better or easier to use that it overcomes the high cost of switching? For a bank, it might be, are new financial technologies making it trivially easy for customers to move their accounts? The third moat is the network effect, where a product or service becomes more valuable as more people use it, like a social media platform or a credit card network. The critical question here is the user base growing, stagnating, or shrinking? Is a competing network gaining momentum and threatening to reach a critical mass that could unravel our advantage? The fourth moat is a cost advantage, stemming from superior processes, scale, or access to a unique resource. The checklist question is, has a new technology or business model emerged that allows a competitor to deliver the same product or service at a significantly lower cost? Has our scale advantage been eroded? Beyond the moat, your checklist must include an assessment of management. Are the leaders of the company still behaving like rational, shareholder-oriented capital allocators? Or have they started to engage in empire building, making expensive, low-return acquisitions just to get bigger? Are they being transparent and honest in their communications, or are they starting to obscure bad news with accounting tricks? Finally, the checklist process must be performed with a look-through discipline. You must force yourself to read the quarterly reports and analyze the business results without looking at the stock price. The stock price is a measure of market sentiment. The business results are a measure of reality. If the business narrative is consistently failing to meet the expectations you laid out in your original thesis, if profit margins are consistently shrinking, if debt is piling up with no corresponding growth in earnings, then the evidence of fundamental deterioration is mounting. This checklist transforms a vague fear into a structured analysis, allowing you to make a rational decision based on business facts, not market noise. The antithesis to this disciplined approach is what can be called the hope and pray strategy. This is the path taken by countless investors who find themselves holding a declining stock. Instead of conducting a rational analysis of the business fundamentals, they fall back on emotion and hope. Their internal monologue is filled with denial and rationalization. It's just a temporary setback. The market doesn't understand this company. It has to come back eventually. Look at how high it used to be. The most dangerous manifestation of this strategy is compulsive averaging down. When the stock price falls, they see it not as a warning sign of a deteriorating business, but as a bargain. They buy more, lowering their average cost basis. This feels proactive, like they are taking control of the situation. But if the underlying business is truly broken, all they are doing is increasing their exposure to a failing enterprise. They are not investing, they are catching a falling knife. A classic cautionary tale is the story of investors who held on to Blockbuster Video in the mid-2000s. They remembered the glory days, the Friday nights spent wandering the aisles, the power of the Blockbuster brand. When a small company called Netflix started gaining traction with its red mailer envelopes, many Blockbuster investors dismissed it as a niche gimmick. As Blockbuster's sales began to decline and its debt mounted, these investors held on. They were anchored to the past, in love with the memory of what the company was, not what it was becoming. They watched the stock price fall from over $20 a share to pennies and eventually to zero. Their hope was not a strategy, it was a wealth-destroying fantasy. They failed to see that the entire business model, physical stores, late fees, limited inventory, was being rendered obsolete by new technology. This is a complete failure of portfolio management. A portfolio is like a garden, it requires periodic weeding. To allow a fundamentally deteriorating business to remain in your portfolio is to let a diseased plant choke out the healthy ones. The hope and pray investor is the gardener who falls in love with his weeds, watering them diligently while his beautiful flowers wither from neglect. Their failure is not just in losing money on the bad investment, it's the opportunity cost of having their capital trapped in a sinking ship instead of being deployed in a thriving one. The direct financial consequence of failing to identify and act on fundamental deterioration is the insidious destruction of capital by what are known as, quote, value traps. A value trap is a stock that appears to be cheap based on traditional valuation metrics, like a low price-to-earnings PE ratio or a low price-to-book PB ratio, but is actually expensive because its earnings and underlying value are in a state of terminal decline. The investor sees a PE ratio of 8 and thinks they've found a bargain, failing to realize that the earnings is on a rapid path to zero. As the earnings fall, the PE ratio for the stock, even at a lower price, will actually rise, and the investor is left holding an asset that is worth less and less each year. Holding onto a deteriorating asset does far more damage than just the initial loss. It creates a powerful headwind against your entire portfolio's performance. Let's quantify this. Imagine you have $100,000 invested. $50,000 is in Company A, a solid business growing its intrinsic value at a modest but steady 7% per year. The other $50,000 is in Company B, a business whose fundamentals are deteriorating, causing its value to decline by 10% per year. You hold both for a decade. The investment in Company A, the grower, nearly doubles to about $98,000. The investment in Company B, the value trap, shrinks to just over $17,000. Your total portfolio value at the end of the decade is about $115,000, a pathetic total return of just 15% over 10 years. Now, imagine a different scenario. After 1 year, you recognize that Company B is a value trap. You use your moat erosion checklist, see the cracks, and sell your position for a loss, getting back $45,000. You then redeploy that capital into another solid business, Company C, which also grows at 7% per year. Now, after the full decade, your initial $100,000 has grown to over $184,000. The single act of identifying the deterioration and reallocating the capital made a difference of nearly $70,000. It is the difference between stagnation and meaningful wealth creation. This is what great executive decision-making looks like in the context of personal finance. A great CEO doesn't continue to fund a failing division out of loyalty or hope. They shut it down or sell it off, and they reallocate that capital to the divisions with the brightest futures. Your portfolio is your personal corporation, and you are its CEO. Your job is to make rational capital allocation decisions, and that includes the decision to divest from failing operations to preserve and grow the value of the enterprise as a whole. While the deterioration of a business is an external event, the second of Buffett's exit triggers is a profoundly internal one. It is the simple yet incredibly difficult act of acknowledging a mistake. This occurs when you realize that your initial analysis of a company, its competitive advantages, its management, its future prospects, was fundamentally flawed from the very beginning. The business itself may not have changed, but your understanding of it has. You have come to the realization that you were wrong. To understand the gravity of this principle, we must examine what Warren Buffett himself has called his worst deal ever. It wasn't his biggest loss in dollar terms, but it was, in his words, his most colossal mistake. The story is that of Dexter Shoe Company. In 1993, Buffett was at the peak of his powers. He was looking for great American businesses with durable competitive advantages. He found Dexter Shoe, a manufacturer of high-quality American-made shoes based in Maine. He was impressed by the company, its brand, and its manager, a man named Peter Lunder. He believed Dexter had a lasting moat. In his 1993 letter to shareholders, he wrote glowingly about the purchase, calling Dexter just the sort of business Charlie Munger and I look for. He was so confident, in fact, that he didn't pay for the company with cash. He paid for it with Berkshire Hathaway stock, issuing shares worth $433 million to Dexter's owners. This was the critical error. Soon after the acquisition, the durable competitive advantage that Buffett thought he saw began to crumble. Low-cost shoe manufacturers from overseas flooded the market, and Dexter's pricing power and profitability evaporated. The moat was an illusion. The business that he thought was worth over $400 million quickly became worthless. But the true cost of the mistake was not the $433 million. It was the Berkshire Hathaway stock he had used to pay for it. The value of that stock, which he had essentially traded for a worthless shoe company, continued to climb as Berkshire's other businesses flourished. Years later, Buffett calculated that the Berkshire shares he gave away for Dexter were worth billions of dollars. He reflected on this with brutal honesty. "I made a mistake in assessing the durability of Dexter's competitive advantage. When you use stock to buy a business, you are saying that what you get is as valuable as what you give. In this case, I was dead wrong." This story is the ultimate testament to intellectual honesty. Buffett doesn't hide his mistakes. He dissects them in public, using them as teaching moments for his shareholders and for himself. He recognized that his initial thesis was flawed. He had misjudged the industry dynamics and the vulnerability of the business. The act of selling a stock because you realize you were wrong is the financial equivalent of this intellectual process. It is the admission that your initial judgment was flawed, and it is a crucial step in preserving capital from your own analytical errors. The immense difficulty of admitting a mistake stems from a pair of cognitive biases that are deeply woven into our mental fabric: confirmation bias and the overconfidence effect. Confirmation bias is our natural tendency to search for, interpret, favor, and recall information in a way that confirms or supports our pre-existing beliefs. Once we've made the decision to buy a stock, our brain subconsciously starts looking for evidence that we made a brilliant choice. We'll notice every positive news article, every bullish analyst report, and every uptick in the stock price as proof of our genius. Simultaneously, we will tend to ignore, discount, or explain away any negative information. If a critical report comes out, we'll question the author's motives. If the company misses earnings, we'll blame the overall economy. Our brain is acting like a biased lawyer, building a case for our initial decision, rather than an impartial judge weighing all the evidence. The overconfidence effect is a well-established bias in which a person's subjective confidence in their own judgments is reliably greater than the objective accuracy of those judgments. We all tend to think we are better than average drivers, have a better than average sense of humor, and are better than average investors. This overconfidence can lead us to make initial investment decisions based on incomplete research, assuming that our intellect will fill in the gaps. Once that decision is made, the overconfidence makes it incredibly difficult to question our own analysis. To admit a mistake is to confront the evidence that we are not as smart as we thought we were, which is a significant psychological blow. Buffett's operational brilliance lies in his lifelong war against these biases. He understands that he is just as susceptible to them as anyone else, so he builds systems to counteract them. He famously seeks out dissenting opinions. He has said, "I'm interested in the reasons why somebody I respect disagrees with me." He doesn't want confirmation. He wants his thesis to be stress-tested by a critical mind. This is the active pursuit of disconfirming evidence. Furthermore, his partnership with Charlie Munger is, in many ways, an institutionalized system for killing bad ideas. Munger is famous for his blunt, intellectually ruthless approach. His most common response to an idea is a simple no. This forces Buffett to defend his reasoning against a formidable and skeptical intellect, catching analytical errors before they turn into billion-dollar mistakes. For an individual investor, the lesson is profound. You must become your own Charlie Munger. You must actively fight the urge to seek confirmation. When you buy a stock, your next step should not be to read articles about why it's a great investment. Your next step should be to find the most intelligent, well-reasoned bearish argument against the company you can find. Your goal is not to prove yourself right, but to discover, as quickly as possible, if you are wrong. This is the core of a powerful trading psychology. Even for a buy-and-hold investor, the humility to accept your own fallibility. To operationalize this principle of intellectual honesty, we need an applied mental model. We can call it the circle of competence audit. This is a framework for preventing mistakes in the first place, and for identifying them quickly when they do occur. The first step is to honestly and brutally define your circle of competence. Take out a piece of paper and write down the industries, business models, and technologies that you understand deeply. Not things you've read a few headlines about, but subjects where you could hold your own in a conversation with an industry professional. Be ruthless in your honesty. Is your circle limited to consumer packaged goods? Retail? Simple software as a service businesses? That's fine. The size of the circle is not important. Knowing its boundaries is everything. The second step is to institutionalize the concept of a too hard pile. This is one of Buffett and Munger's most powerful tools. If a business is too complex, if its technology is too opaque, if its financial statements are too confusing, you don't try to get smart on it. You put it in the too hard pile and you move on. There are thousands of publicly traded companies. You only need to find a few good ones within your circle of competence. This discipline prevents you from making the most common type of mistake, investing in something you don't truly understand. The third step is to implement a mistake analysis protocol. When one of your investments is performing poorly, not in its stock price but in its underlying business results, you must resist the urge to blame external factors. Instead, you must get out your original pre-mortem purchase analysis and conduct a formal review. Ask yourself, was my initial thesis incorrect? Go through it line by line. Did you dramatically overestimate the size of the market? Did you fail to appreciate the strength of the competition? Did you misjudge the character or ability of the management team? The goal is not to beat yourself up, but to perform a clear-eyed diagnosis of the analytical error. Finally, to truly learn from this process, you should create a mistake journal. Keep a dedicated log of your investment errors, both of commission, buying something you shouldn't have, and omission, failing to buy something you should have. For each mistake, write down what the error was, why you made it, and what you can learn from it. Over time, this journal will become one of your most valuable assets. It will reveal your personal patterns of error. Do you consistently fall for story stocks with no profits? Do you have a blind spot for technological disruption? This journal is the foundation of a real-world financial education, one tailored specifically to your own psychological weaknesses. It transforms your mistakes from painful losses into priceless tuition. The antithesis of this humble self-critical approach is the ego-driven investor. This individual's portfolio is not a collection of business interests. It is a reflection of their own self-worth. Every stock they pick is a testament to their intelligence, and any decline in price is not a potential error on their part, but a personal attack by an irrational market. This investor can never, ever admit they were wrong. If a stock they own goes down, they have a ready-made list of external scapegoats. It's the Federal Reserve's fault for raising interest rates. It's a conspiracy by short sellers to drive the price down. It's market manipulation by unseen forces. It's the media spreading FUD, fear, uncertainty, and doubt. They will construct elaborate, often conspiratorial narratives to explain away the poor performance, because the alternative, the simple admission that my initial judgment was flawed, is too painful for their ego to handle. Because their ego is on the line, they don't just hold on to their mistakes, they often double down on them. Buying more of a falling stock becomes an act of defiance, a way of proving to the foolish market that they, the brilliant individual, are right. Their decision-making is no longer guided by a rational assessment of intrinsic value, but by an emotional need to be vindicated. This is a perilous path. The market can remain irrational far longer than an individual can remain solvent. The ego-driven investor's portfolio often ends up becoming a concentrated collection of their worst ideas, as the winners are sold to take profits, and the losers are held and added to out of stubborn pride. They violate the most fundamental rule of investing: cut your losers and let your winners run. Instead, they let their losers run amok and cut their winners at the stem. This is not an investing strategy. It is a psychological pathology, a direct route to financial ruin, driven by the most dangerous emotion an investor can have: the refusal to admit a mistake. The financial implications of distinguishing between a temporary price drop and a genuine analytical mistake are profound. It is the difference between a golden opportunity and a permanent impairment of capital. When the stock price of a truly wonderful business that you understand well drops by 30 or 40% due to a general market panic or a temporary, solvable problem, that is a gift. It's the market offering you the chance to buy more of a fantastic enterprise at a discount. This is when you should be greedy when others are fearful. However, when a stock price drops because you have realized that your initial thesis was wrong, that the company's moat is not as strong as you thought, or its management is not as skilled, that price drop is not an opportunity. It is a warning. It is a signal that the intrinsic value of the business is also declining. To hold on in this situation, or worse, to buy more, is to commit your capital to a permanently impaired asset. Correctly identifying a mistake and acting on it by selling, even at a significant loss, is one of the most powerful acts of capital preservation an investor can make. Imagine you invested $10,000 into a company based on a flawed thesis. The stock drops by 30% to $7,000 as the company's problems become apparent. You have two choices. The ego-driven investor holds on, hoping to get back to even. The business continues to struggle, and the stock eventually drifts down another 50%, leaving him with just $3,500, a 65% permanent loss of capital. The rational investor, however, conducts a mistake analysis. She recognizes her thesis was flawed and sells, accepting the 30% loss and recovering $7,000 of her capital. She then takes that $7,000 and invests it in a great business that she understands well, which proceeds to double in value over the next few years. Her capital is now at $14,000. The decision to admit the mistake and sell at a loss was the very act that enabled her to turn a losing situation into a winning one. It freed her capital from a failing enterprise and allowed it to be redeployed into a productive one. The math is undeniable. Selling a mistake is not an admission of failure. It is an act of professional portfolio management. It is the recognition that your most valuable asset is not any single stock, but your capital itself. And the primary duty of a good manager is to protect that capital from your own errors in judgment. We arrive now at the third and final reason Warren Buffett will ever sell a stock. It is the most forward-looking and opportunistic of the three. He will sell a holding if he finds a demonstrably superior investment alternative, This isn't about selling something that has gone bad or something that was a mistake. This is about selling a good investment to fund a truly great one. It is the principle of opportunity cost in its purest and most ruthless form. A telling, though complex, example of this thinking can be seen in his handling of his Freddie Mac investment in the late 1990s. Buffett had owned the mortgage giant for years and had made a handsome profit. It was a good business. But as the decade wore on, he became increasingly uncomfortable with the way management was running the company. He felt they were taking on more and more risk with derivatives and were becoming obsessed with hitting quarterly earnings targets to please Wall Street, rather than focusing on building long-term low-risk value. In his mind, the quality of the business was declining, making it a less attractive long-term holding. He began to trim his position. But the real key here is what he was doing with that capital. He was constantly scanning the universe of other opportunities. This was the era of the dot-com bubble, and while he famously avoided the tech stocks, he was finding value in other, less glamorous sectors. He was comparing the risk-adjusted future returns of holding Freddie Mac against the potential returns of these other ideas. He concluded that he could deploy the capital tied up in a good but increasingly risky business into other businesses that were great and safer. He eventually sold his entire position before 2000, avoiding the accounting scandals and eventual government bailout that would rock the company years later. The most profound example of this principle, however, is the very existence of Berkshire Hathaway itself. Berkshire Hathaway began as a struggling New England textile mill. When Buffett took control in the 1960s, he quickly realized that the textile business was a terrible one, facing relentless foreign competition and requiring huge capital expenditures just to stay afloat. A normal manager would have tried to save the textile business. Buffett, however, saw it as a source of cash flow that could be used to buy into far superior businesses. He began to use the small profits from the dying textile operations to buy insurance companies, like National Indemnity. He understood that insurance was a much better business, one that generated float, premium dollars that could be invested for Berkshire's benefit. He was, in effect, selling the textile business piece by piece and reallocating the capital to a vastly superior opportunity. He didn't fall in love with the business he owned. He was ruthlessly focused on finding the best possible place to put his capital. This is the ultimate form of executive decision-making, the discipline to move resources from an area of low return to an area of high return, thereby maximizing the value of the entire enterprise. The psychological barrier that prevents most investors from acting on this principle is a pervasive cognitive blind spot known as opportunity cost neglect. Opportunity cost is a fundamental concept in economics, the value of the next best alternative that you give up when you make a decision. When you choose to spend 2 hours watching a movie, your opportunity cost is whatever else you could have done with those 2 hours, like reading a book or exercising. While we intuitively understand this in our daily lives, we are remarkably bad at applying it to our investment portfolios. Most people look at their portfolio and see a collection of assets. They might see a stock they own, let's say a big utility company, that has been doing okay. It provides a decent dividend and chugs along, growing at maybe 6 or 7% a year. They are content with this. The position is in the green, it's not causing them any stress, so they leave it alone. What they failed to do is ask the critical, Buffett-like question. Is this utility stock the absolute best place for my capital to be for the next 10 years out of all the thousands of potential investments in the world? They don't actively compare their okay holding to a potentially spectacular new opportunity. The okay investment's mere presence in their portfolio makes it seem like the right choice, an extension of the status quo bias we discussed earlier. Buffett's mind is wired differently. He is constantly, obsessively running a mental competition. Every asset Berkshire owns is in a perpetual battle for its place in the portfolio. Its opponent is every other potential investment opportunity on the planet. He is running a continuous, internal best-of contest. This relentless comparison forces a discipline that is almost unheard of. It means that no investment gets a free ride. Just because it was a great idea 5 years ago doesn't mean it's the best place for capital today. This is an incredibly demanding mental exercise. It requires not just identifying new great ideas, but also having the conviction to sell a comfortable, familiar, and profitable current holding to fund the new one, especially after accounting for the friction costs of taxes. Most investors shy away from this because it's hard work and it feels risky. Selling a proven winner to buy something new feels like leaving a safe harbor for the open sea. But for Buffett, it is the very essence of capital allocation. It is the engine of optimization that ensures his capital is always working in its highest and best use. To put this powerful concept into practice, you need a structured mental model. We can call it the relative value scorecard. This is a system for forcing the ruthless comparison between what you own and what you could own. The first step is to establish a personal hurdle rate. This is your minimum acceptable rate of return for a long-term investment. This rate should be ambitious but realistic, perhaps something like 15% annualized. This hurdle rate is the bar that every investment, both current and potential, must clear. If you don't believe an investment has a very high probability of exceeding this rate over the long term, you shouldn't even consider it. The second step is to create a scorecard for your current major holdings. For each position, you need to score it on a simple scale, say 1 to 5, across several key metrics. These could include the expected future growth rate of the business, the strength and durability of its economic moat, the quality and integrity of its management team, and critically, its current valuation relative to its intrinsic value. A high score means it's a great business at a great price. A low score means it's a mediocre business or a good business at an expensive price. The third step is to maintain a watch list of potential new investments that you have researched and understand well. You must apply the exact same scorecard to these watch list companies. This creates an apples-to-apples comparison between the assets you own and the assets you are considering. The fourth and most critical step is the ruthless comparison. Once or twice a year, you conduct a portfolio review. You take your lowest scoring current holding and you place it side by side with your highest scoring watchlist company. You must now answer the question, is this new opportunity so demonstrably superior to my worst current holding that it justifies the action of selling and reinvesting? Notice the high bar. The question is not, is the new idea slightly better? It must be overwhelmingly, compellingly better. Finally, you must explicitly factor in the friction. The new opportunity's expected return must be so high that it not only beats the expected return of your current holding, but also covers the capital gains taxes you will have to pay on the sale. This is a crucial governor on the system, preventing you from trading too frequently. It reinforces the natural bias to hold, ensuring that you only make a change when the opportunity is truly extraordinary. This scorecard system transforms a vague sense of opportunity cost into a concrete, data-driven decision-making process. It forces you to be an active and rational CEO of your own capital, not a passive collector of stocks. The path of the 99% stands in stark contrast to this focused, high-conviction approach. The average investor often becomes a collector, a person who diversifies for the sake of diversification, mistaking a large number of holdings for safety. Their portfolio becomes a cluttered and unfocused museum of past ideas. They buy a stock based on a tip from a friend, another based on a news headline, and a third because it's in a hot sector. They rarely, if ever, sell an existing position to fund a new one. They just keep adding. The result is what Peter Lynch famously called diversification. Their portfolio grows to 30, 50, or even 100 stocks. At this point, they have effectively created their own personal, high-fee, inefficient index fund. They have no real conviction in any single holding, and the performance of their few great ideas is drowned out by the mediocrity of the many average ones. They are not thinking about asset allocation in a strategic way. They are simply accumulating tickers. They are like a general who sends a single soldier to fight on 100 different fronts, ensuring that he has no real strength anywhere. They have completely neglected the concept of opportunity cost. They are not asking if each holding is the best possible use of their capital. Instead, their portfolio becomes a reflection of their past impulses rather than their best current thinking. This is not a strategy for building wealth. It is a recipe for guaranteed mediocrity. True wealth is not built by spreading your capital thinly across dozens of mediocre ideas. It is built by concentrating your capital in a small number of truly outstanding businesses and holding them for the long term. The direct financial connection of this principle is the creation of concentrated alpha. Alpha is the financial term for returns that are above and beyond the market average. It is the measure of an investor's skill. And significant sustainable alpha is almost never achieved through broad diversification. It is achieved through intelligent concentration. By systematically selling your good ideas to fund your great ideas, you are actively increasing the quality and expected return of your overall portfolio over time. Think about it from the perspective of a successful entrepreneur or a skilled CEO. A great business leader does not allocate capital equally to all of their company's projects. They identify the 2 or 3 initiatives with the highest potential return on investment, and they starve the other projects to pour resources into those potential game changers. This is how great companies are built. Your portfolio should be managed with the same ruthless focus on return on investment. Let's quantify the impact. Imagine an investor with a portfolio of 50 stocks, where the average expected return is 8% per year, tracking the market. Over 20 years, a $100,000 investment would grow to about $466,000. Now consider a focused investor who uses the relative value scorecard. They hold only 10 to 15 businesses, and because they are constantly upgrading their portfolio by selling their weakest ideas to buy stronger ones, their average expected return is 15% per year. Their $100,000 investment over the same 20 years would grow to over $1.6 million. That is the power of a concentrated, high-conviction strategy. It's the difference of more than $1 million, generated not by taking on more reckless risk, but by applying a more disciplined and rational process of capital allocation. This is the essence of sophisticated wealth management. It's not about being a stock market wizard who can predict the future. It's about being a disciplined business manager who understands that true performance comes from focusing your precious resources on your absolute best ideas. We have now journeyed through the 3 sacred reasons for a sale, the intellectual triggers that can override the powerful forever mandate. But to truly understand how this system works, we must look at the unseen architecture that holds it all together. This is not about a single decision, but about building a personal and financial structure that makes this level of patience and discipline possible. It's about constructing a fortress of temperament and solvency that allows you to ride out the inevitable storms of the market. The ultimate case study for this is not just a single investment, but the entire arc of one of Buffett's greatest triumphs, the Washington Post Company. In the early 1970s, the market was in a funk, and newspaper stocks were particularly unloved. The Washington Post, despite being a premier media institution, saw its stock price pummeled. Buffett, however, saw the reality behind the sentiment. He saw a newspaper with a near-monopoly position in a major capital city, a powerful brand, and a growing television station business. It was a fantastic economic franchise being offered at a ridiculously cheap price. In 1973, he invested about $11 million, buying up a significant chunk of the company. Then came the hard part. The market continued to languish. The stock price went down after he bought it. For years, the investment didn't seem to be going anywhere. A lesser investor would have panicked, questioned their thesis, and sold out. But Buffett had 2 things on his side. First, his intellectual conviction was absolute. He had done the work, he understood the business, and he knew it was worth far more than the market was quoting. Second, and just as important, was his structural advantage. Berkshire Hathaway's insurance operations provided a constant flow of new capital. He was never under any pressure to sell his holdings to raise cash. He was not a forced seller, he was a permanent owner. This combination of intellectual conviction and structural permanence allowed him to simply wait. And wait he did. He held onto his Washington Post shares for over 3 decades. Over that time, the company, led by the brilliant Katharine Graham, flourished. That initial $11 million investment grew to be worth over $1 billion, a return of more than 100-fold. This is the ultimate synthesis of the entire philosophy. Identify a wonderful business, buy it at a fair price when others are fearful, and then structure your life and finances in such a way that you can give it the decades it needs to work its compounding magic. The secret weapon that allows an individual investor to emulate this strategy is the exploitation of what we can call time horizon arbitrage. In the world of finance, an arbitrage is a risk-free profit opportunity. Time horizon arbitrage is the closest thing a retail investor has to one. The vast majority of money in the market today is managed by professionals, hedge fund managers, mutual fund managers, pension fund operators. And these professionals, despite their intelligence and resources, have a fatal flaw. They operate on short time horizons. A hedge fund manager who underperforms the S&P 500 for 2 consecutive quarters faces redemptions from their clients. A mutual fund manager is judged on their 1-year and 3-year performance numbers. This immense institutional pressure forces them to think and act for the short term. They cannot afford to own a stock that might underperform for a year or two, even if they believe its 10-year prospects are spectacular. They are slaves to the quarterly earnings cycle. You, as an individual investor, have no such constraints. You have no clients to answer to. Your time horizon is not the next quarter. It is the next several decades, until the day you need the money for retirement or to pass on to the next generation. This is a staggering advantage. You can buy a great business that is facing a temporary, solvable problem that has scared away the short-term money, and you can patiently wait for the problem to be solved and the value to be recognized. You can ignore the market's manic depressive mood swings, knowing that over the long run a company's stock price will ultimately follow the trajectory of its underlying earnings power. Overcoming the psychological pressure to keep up with the market in the short term is the key to unlocking this advantage. There will be years when your focused portfolio of wonderful businesses underperforms a hot, speculative market. You will feel foolish. You will be tempted to abandon your strategy. But if you can master your own emotions, if you can keep your focus on your multi-decade horizon, you can exploit the market's obsession with the present moment. You can trade their short-term impatience for your long-term profit. To wield this advantage, you must build what can be called a personal fortress. This is a blueprint for structuring your finances and your mindset to enable long-term patient investing. The first and most critical component is structural solvency. You can only be a long-term investor if you are never forced to sell your assets at an inopportune time to cover a life expense. This means you must have a separate, fully funded emergency fund in cash or cash equivalents to cover 6 months of living expenses. It means you must have no high-interest debt, like credit card debt, which acts as a powerful anti-compounding force against your portfolio. Financial solvency is the bedrock upon which all successful long-term investing is built. The second component is temperamental control. You must consciously design your environment to protect you from your own worst emotional impulses. This means deleting the stock tracking apps from your phone. It means turning off the financial news. It means developing rituals that disconnect your emotions from daily market fluctuations. Your focus must shift from the noise of the market to the signal of the business. You must train yourself to get excited by a great earnings report, not by a green arrow next to a ticker symbol. This is about mastering trading psychology without ever becoming a trader. The third component is building your intellectual framework. The best antidote to the fear caused by price volatility is a deep understanding of the underlying business. The more you learn about business strategy, accounting, and competitive analysis, the less the stock price will intimidate you. When a stock you own falls 50% if you don't truly understand the business, you will panic. If you understand the business intimately and are confident in its long-term prospects, you will see the price drop as a wonderful buying opportunity. True financial education is not about learning to read stock charts, it's about learning to read a balance sheet and a business model. Finally, the ultimate rule for your asset allocation, the capstone of your personal fortress, is the sleep at night test. You should only own a collection of businesses that you understand so well and believe in so strongly that you could watch your portfolio get cut in half during a market crash and not lose a moment of sleep. In fact, if your reaction to a 50% market decline is not fear, but a greedy excitement about the bargains on offer, you know you have constructed your fortress correctly. The antithesis to this patient fortress-building approach is the get-rich-quick market timer. This individual believes they possess the secret skill of predicting the short-term movements of the market. They are not investors. They are speculators, treating the stock market like a casino. Their decisions are driven by headlines, by Federal Reserve announcements, by technical analysis patterns on a chart, or by the latest hot tip they heard on social media. They are constantly jumping in and out of the market, believing they can sell at the top and buy back at the bottom. The reality is that this is an impossible game. Inevitably, they do the exact opposite. When the market is crashing and fear is at its peak, their own fear takes over, and they sell everything near the bottom, locking in devastating losses. Then, when the market has recovered and is reaching new highs, when euphoria is rampant and every headline is positive, their greed kicks in, and they pile back in near the top, guaranteeing themselves poor future returns. They consistently buy high and sell low, the exact inverse of a sound investing strategy. They mistake volatility, the normal up and down movement of the market, for risk, which is the permanent loss of capital. They mistake activity for progress, believing that their constant trading is a sign of engagement and skill, when in reality it is just generating commissions for their broker and taxes for the government, all while destroying their own returns. The market timer has no coherent investing strategy. They are a leaf in the wind of market sentiment, and their financial future is left entirely to chance. The ultimate direct financial connection, the grand prize for embracing this entire philosophy, is the achievement of true financial freedom. This disciplined, patient, business-focused approach is not a get-rich-quick scheme. It is the most reliable, time-tested path to building significant, sustainable, and generational wealth. The goal is not to find the next hot stock that will double in a month. The goal is to become a part owner of the world's most durable and profitable enterprises, and then to sit back and let the magic of long-term, tax-deferred compounding do the heavy lifting for you over a lifetime. By avoiding the constant frictional costs of active trading, the commissions, the bid-ask spreads, and most importantly, the steady drain of capital gains taxes, you keep your wealth compounding machine intact and running at its maximum potential. The financial advantage is almost incalculable. It is the difference between ending up with a modest nest egg and building a fortune so significant that it changes your family's trajectory for generations to come. This is the final promise. It is the transformation from a nervous speculator, tossed about by the whims of the market, into a calm, confident, and prosperous owner of businesses. It is the reward for choosing discipline over impulse, patience over activity, and long-term wisdom over short-term cleverness. This is the architecture of lasting wealth. You have just invested your most valuable asset, your time, into acquiring a powerful mental tool. You now possess the three-point checklist that a master capital allocator uses to govern the most difficult decision in investing: when to sell. You understand that the default should be forever. You know to sell only when a business has fundamentally deteriorated, when you've realized your initial analysis was a mistake, or when a demonstrably superior opportunity presents itself. This framework is designed to remove emotion, override your worst cognitive biases, and anchor your decisions in business logic rather than market noise. It is a profound upgrade to your financial operating system. But what you have mastered today is a single crucial component within a much larger, interconnected system of thought. Warren Buffett's success is not the result of one single mental model, but a lattice work of them, each one supporting and amplifying the others. The selling framework you've just learned is incredibly powerful, but its true potential is only unlocked when it's connected to the principles of valuation, of identifying economic moats, and of assessing management quality. It is a piece of a map, a vital and powerful piece. But a map is not complete with only one section. The video that is now on your screen is not just another video. It is the next piece of that map. It is the link that connects the discipline of selling to the art of buying. It is the key that will help you understand how to find the wonderful businesses that are worthy of being held forever in the first place. The journey to becoming a truly sophisticated investor is a step-by-step process of assembling this complete mental arsenal. You have already taken a massive step forward today. The choice now is whether to stop here or to continue your ascent. The click you are about to make is not just a click to watch another video. It is a decision to continue forging your new identity as a disciplined long-term investor. It is your commitment to completing the map. Click, and let's take the next step together.